I've always thought that most traders aren't very unique. You've probably taken like 100 things from all these different people you've been introduced to, and that kind of makes you your unique trader.
Do you have a time period in mind where you will look at a system?
I thought he was crazy. I was like, how are you just shorting the open and then exiting it closed? This is ridiculous. Like, there's no strategy. It's just, you're just shorting gappers. Like, this must be really terrible.
Because you are systematic, and most people would think that way too. Like, they think it's just that simple. Like, once I have a system that works, I can just easily throw all my money in it.
Oh, this is cracked. I've got it now. I'm just shorting it open. This is all I need to do, and I'll be fine.
Oh, that's awesome, though. Welcome back, everybody, to Be The Trader. Today is going to be a fun day because I have Mounir, aka Goes Hawk Trades. If you don't know who he is, then you need to follow this man on Twitter because he shares some great wisdom around backtesting and his own personal journey. And we're going to find out about his story today, so don't you worry. Welcome to the show, brother.
Thank you so much for having me on. I've been watching your show for a good time now, so I'm really pumped to be on it.
Oh my God, I appreciate you saying that, dude. That's wild to hear. I appreciate that, and it's awesome to talk to you. I'm excited to learn about your story. So, what really got you into the whole world of investing and trading?
Sure. So, ever since I was young, I was really into finance. Originally, I really wanted a job in like the finance industry, whether that be an accountant, investment banking, hedge funds, really anything like that. Not any really specific reason for that. I think I've always been motivated by money, and that was kind of the main way you get money in the UK at least. So that started me down a road of trying to get into the markets. So I think around 17 is when I started doing like a dividend trade strategy. This wasn't very effective because I had a very small amount of money, but it was something. I made a couple pounds here and there every week or so. So that's how I originally started, and then I kind of gave up on it for a while. I went down a whole different route. I started playing semi-professionally for a couple games.
Cool.
I didn't make any crazy money like Brian Lee, but I made enough where I had some starting capital, and that's really where once I had that capital, I was like, might as well trade, might as well go back to that route, maybe I can 100x my money or something like that. So I got into really there, and then I started exploring YouTube, going through different rooms, and that was pretty much it.
Okay. So what kind of games did you play?
So I was a DPS in Overwatch. So I played in Contenders and a couple other arenas around that area. Also played a bit of CSGO. That was kind of how I made my money for a time.
Okay. I hope you still got skills because we'll talk about that later.
So we'll see, maybe.
Yeah. I love games. So, but I'm curious though. So you said you made some money in the gaming world, enough to stake yourself. Then you start to dive into learning with like YouTube. I mean, what happens next? I mean, like you start to trade, not dividends, right? Like what'd you do next?
So the first main introduction I can really remember was Humble Trader. I think I stumbled across her kind of videos. I did a deep dive. I was watching all her really old ones when she was in her old little room and like she was just on like a single webcam and stuff. Those were great videos.
Oh, wow.
Yeah. That's where I learned. I think she did do a video on like the gap and crap setup. And that was the main place I learned it. So after watching all her kind of videos, I was like, hey, I'll join her room. I think it was like $100 or something like that back in the day. So I joined that, and then I realized mainly she was a large cap trader. So I didn't like large caps really at all. They were too slow. It wasn't patient enough. Didn't have enough capital for really large caps. I could only do like a couple shares, something like that. So I met a guy in the room, which was called Luis. I think if I remember correctly, and he did small caps. So I really got into small caps. Lower price per share, so you could get a ton of shares, tons of volatility. Shorting, all the things that gets everyone attracted to small caps kind of got me attracted as well. And then I just started doing small caps I haven't really ever changed. This is the weird thing, is I've never changed my strategy so much. I've just had more conviction and got better at execution. So for the first whole year, I was just slamming small caps and making no money. I would short like every extension. I would try and add to it, and then it would reclaim VWAP, and I'd get stopped out. I would do all the classic kind of mistakes of over leveraging, really just everything with trade zero. And yeah, that's kind of how I got into it, at least at the beginning side.
So you start, okay, this is really interesting because a lot of people, I mean, I've had mixed feelings myself with runes, but overall what I feel like is important is what you just said, is like getting involved and around communities, no matter which community it is so important because then you meet people that could
Yeah.
potentially help you go down a different path. So I'm glad you shared that. So you meet this guy, he shows you about small caps, you start diving into there, and don't have success right away. You just focusing all around. Like, were you trading everything and anything? Were you narrowly focused right away, even though you weren't having success? Like, how was that part?
So I'm quite an obsessive person. Like to focus on one thing and then go very hard on that one thing. So once I identified that small caps was kind of more my fit, I liked shorting. It made more sense to me just logically as well. I went into kind of everyone else's, not necessarily room, but just education about small caps. So, you got the classics like Steven Ducks, Tim Rigatani, and then I started going on Twitter as well, which was a huge kind of like key pivotal moment to introduce me to not so much like all the classic names, some really useful people as well on Twitter that I kind of gained info from. And that was mainly the main way I started learning more about it and got better at it, was just by learning from others. I've always thought that most traders aren't very unique. You've probably taken like 100 things from all these different people you've been introduced to, and that kind of makes you your unique trader. So probably anyone could find remnants of Steven Duggs and Tim Brittani and Day Trading Zoo all in my trading, because I've probably just stolen things from them of whatever they put online.
Cobra Trading is the go-to broker for day traders and short sellers. And I'm not the only one saying this. In fact, Benzinga awarded Cobra Trading as the go-to broker for short selling. They have a heavy focus on direct market access order routing, so you have the fastest execution. They have some of the best locate prices and availability. They also have amazing customer service. I've experienced many different brokers, and it's why I use them every single day and why I'm proud to have them as our sponsor. Sign up now by clicking the Be the Trader referral link below and earn 1 free month of software with Cobra and 25% off all commissions. Now let's get back to the show. That's pretty cool. And so how did you do that though? Because I'm sure there's people right now who follow tons of traders, but they're probably not learning from those traders. So how did you go about, like, what kind of mindset did you have to, like, you're following all these people, you're watching all this stuff, and you knew that you wanted to focus, that's important. Like, you wanted to focus on small caps and you wanted to focus on shorting, so you know who to focus on. But like, what did you do to, like, reverse engineer, if you will, or what did you do to learn by watching?
Good question. I think overall what I did was I was a heavy note taker. So a lot of videos, especially with now AI, it makes it even easier if you're taking notes on videos and things like that. But back then I was mainly just going through videos, normally like 1.2x speed, taking some notes of whatever I think is like most useful. At the time, I was kind of, I think, quite simplistic. I was mainly just looking for like entry parameters or whatever they say to how to like enter. I didn't really focus on the whole psychology side or stock selection, those kind of things. I was looking for the golden nuggets of whatever would make me profitable, which definitely didn't make me profitable straight away. But those helped over time while adding everything else in. But yeah, mainly just note taking was the big one. I use Notion. Evernote is also a great resource. And I've been a very avid person of creating a huge playlist on YouTube of just all my favorite videos and then just going back and rewatching. So if I'm ever feeling bored, I just rewatch the old videos, and that kind of reminds me, maybe sometimes I'll notice something new and something that's like I want to introduce into my trading or something like that. And that's been the key part.
Have you ever noticed anything new from rewatching something?
Oh yeah, hundreds of times.
I
would say to yeah. You should watch. My kind of routine is normally I watch a video, then I wait like 2 weeks or so. It's not like calculated, but it's about 2 weeks or so.
Yeah.
And then I'll go back and watch it again, and I'll probably find one or two kind of like new things that I want to introduce or take on board.
Yeah, I love that. It's I probably heard Day Trading in the Zone hundreds of times. Now every time I hear something different. It's insane.
Yeah.
So you're focusing in, you're taking notes. Now, how long did it take you to really find something that you could be consistent with, and you start to see some progress, maybe some profits? How long did that take? Because I know you said you were trading for a little while in 2017, and tell me where we are now when you start to find some kind of like some type of something that works for you.
So it wasn't 2017, it was when I was 17. So I officially started trading, no worries. I started trading in 2019, around the start or so. And then started seeing some consistency about a year and a half into my trading also.
Yeah.
That was when, just before that, like 6 months before that, I'd become more systematic and I'd started going down the route of like using data and really implementing things like that. And 6 months after absorbing a lot of that knowledge, I started to see a bit more consistency. That wasn't necessarily like being profitable in the year or anything like that. It was more a more consistent like uptrend on my equity curve, pretty much.
Yeah.
So at the end of that year, I ended just above kind of break even. So I was profitable, but it wasn't anything crazy. And then 2 years after, I've been profitable like for 2 years, pretty much.
Awesome, man. And so you said after about 6 months, you went to more systematic. Can you explain what made you do that? Like what triggered you to be like, oh, let me try this approach instead of discretionary?
Yeah, sure. So it was coming to the end of kind of year one of me trading, and I hadn't made any progress, hadn't made any money, lost a lot of money, spent a lot of time, and I came to kind of a pivotal moment where I'd taken a big loss on a trade. It was completely stupid. I'd made some mistake of my own, and I realized I just wasn't very good at discretionary trading. And I spent a lot of time breaking it down into, okay, like, what could potentially I'm missing? Is it just experience? Is it just time? Do I need to apply more time? Those kind of things. And just before that kind of time, I'd been introduced into someone that was doing like an open to close system. His name, I think, if it's still correct, it's Short Baggy on Twitter. And I saw him. And at the time when I saw him, I thought he was crazy. I was like, how are you just shorting the open and then exiting it closed? This is ridiculous. Like, there's no strategy. It's just, you're just shorting gappers. Like, this must be really terrible. So I started to dive in more into that kind of approach and understand, okay, why is he doing this? He seems profitable on Twitter. Like, is there anything to it? And that started me getting down the rabbit hole of going into systematic trading. So the main reason I switched was because I was so bad at discretionary trading. And I realized, okay, discretionary trading is going to be built over time and experience. So if I don't want to burn out trading because I'm so annoyed at myself after a whole year, let me try a different approach while also watching the markets, learning, keep on experimenting. And that was kind of where I've continued to go. As I think, like, once I've been trading for 10 years, I'll probably be more discretionary than I am now. But because I'm only at like 4 years and a half, I'm a 20% split discretion and then 80% systematic. And that data is kind of filling in my void of unexperience. I don't know everything. I haven't experienced everything, but this data can at least teach me a lot of that and show me a lot of that. And that's why I've also seen, like, when I've ever worked with a trader that has a lot of experience, they're amazing because they have so much experience. And then once they add data to them as well, they have that whole new level of conviction. They can optimize way better. It's just crazy.
That's cool, man. And so you switched it just to systematic, and pretty quickly, like, did you start to see progress? And how did you even teach yourself the systematic approach? Like, did you learn that from like just YouTube? Like, how'd you learn that?
So I would say teach is probably an overstatement. It was kind of just copying people's executions, really. So like the guy I mentioned, he was doing open to close. So I was like, okay, if there's a gapper on the day, let me short it at open. I'll use some crazy wide stop because I'd seen he's been using like 20 or 30%. And that would be kind of the way I'd go about it. So I was like, okay, this is pretty simple. As long as I stick to the execution, as long as I stay disciplined, it should be fine. And that allowed me to see some consistency. The main reason was at the time, if I remember correctly, small caps was in kind of a weak cycle. So everything was just fading. So when I did it, I think after the first week, I thought I was a genius. I was like, oh, this is cracked. I've got it now. I'm just shorting it open. This is all I need to do, and I'll be fine.
Oh, that's awesome, though.
Yeah. After some time, once the cycle kind of like changed, I was like, okay, this definitely doesn't work. I'm taking 30% losses day after day after day because of, like, I think there was some news hype or something.
There was a period where small caps would crap and then consolidate at the lows all day and then go new highs at the end of the day. There was a period like that for a year. I feel like it just kept doing that.
Yep. I think I remember that time because that was when I started experimenting more with data and seeing, like, okay, is there an actual reason why all these things are reclaiming like near end of day? So that made me introduce rules into my trading where I was like, if something is holding up around VWAP for way too long, so like let's say it's like 2 p.m., 3 p.m., and it starts to make a new high, I'm getting out of it because there's just realistically on an odds basis, it's way lower chance that that's going to go all the way back down and you're going to be profitable. It's just a way lower chance. So might as well like get out now, take that kind of smaller loss or maybe your loss at the moment and not have to experience any of that crazy action at the end of the day.
Dude, that's cool, man. And I like how you're just talking right now. It's really interesting. Like, I picked this up because I've been trading for a long time, but I think people need to understand, like, listen how Ghost Hawk is explaining some things. Like, for example, you just said, I know that between, you were just kind of spitballing here, so I'm not going to hold you to it, but around the 2 or 3 o'clock
Yeah.
hour, if things are holding for too long around VWAP, the odds are not in my favor to even reclaim. If it reclaims, that's going to go back for profits in my favor. Like, that way of thinking has probably built your confidence so much further into helping you execute on a regular basis, helping you know that you're not taking your profits too soon. You know what I'm saying? And be like, oh, I'm upset because I just took it off because I was nervous. But now you have a system approach behind that. Like, did that come easy to you to like build a system and to actually like create it? Because I know you said you kind of did it on your own, kind of like slowly by copying other traders, but like, you copying them, but then what happens next? Like, you're just actually trading it open to close. How did you convert that theory and that execution to testing it and like doing it all for you and then really get more confidence behind that?
Sure. So I'd say the confidence part definitely comes from data. I've heard different opinions on it. At least for me, data has been a thing that I've been able to put my confidence in, and that conviction comes into my trading. So I'm more disciplined nowadays because I have trust in the numbers. It doesn't work for everyone. I've definitely heard some people where they don't trust numbers and they think it's, I don't know, it's more scary to trust it than themselves. But for me, it's always been way easier to believe in numbers than it is to believe in myself. I think the main reason why that is because the whole first year proved to me I couldn't stick to things most of the time. Most of the time, I'm going to have some kind of bias I don't even know, or I'm going to feel a bit differently on the day. So I've been able to just kind of take that confidence in myself and just put it straight into numbers, and that's helped me execute better. For the testing side of things or creating a strategy, it's a long process, and I made a lot of mistakes along the way, to be honest, probably all the classic ones. A lot of it comes down to you've kind of got around 4 different parts. You have an idea, so that's whether you find someone online and you think, oh, that's something cool I should test, or whether that
Use
be
your
for a
buddy
book
as an
or
example, the one open and close.
Oh, right, yeah, sure. So I'd see his charts and I'm like, okay, he's shorting around open. That seems pretty self-explanatory, and he's exiting most of the time at close, or he's stopping out at around like this 30% area. So that's a very easy strategy to backtest. So we've got that kind of requirements, we've got that definition. Then we go into collecting data on it. So this is where you can either go down a manual path, so you can collect data manually, or you can sometimes use software or coding to pull data, which saves you a lot of time in my experience, and also reduces any biases from like manual collecting data. Because I did spend, during those like original 6 months, I spent a lot of time manually tracking data, and the main things I came out with it was, okay, there's a lot of biases here. I've messed up some of my data tracking. I've spent a lot of time. It's kind of annoying to do at the end of the day, and a lot of the time it just wasn't worth it for what I would actually find out from the data. Whereas now I can pull like 5-10 years of data, and it takes me a couple of hours, and that allows me to actually like test and do something that's more useful with my time, which is most of the time your time should be analyzing data, not collecting data. That's just the boring part that you don't really need to do that much. So after you get that kind of data, you'd go through, you'd run some simulations. They can be as complex as you want or as easy as you want. So something like this, where open to close, that's very, very simple. You're just shorting the open price and exiting at end of day or at a stop. You can do that even through Excel. Like an open to close, you can definitely do through Excel. It's very easy, just using the if formulas and things like that. And then after that, I'm normally doing some kind of robustness testing. So whether that be like Monte Carlo simulations, parameter sensitivity. Main reason for that.
What the hell is
sorry?
that? I don't even know what that was. What was that?
So robustness testing it comes onto the part that trading, or at least the market, is all a random distribution. So you could have a strategy that's got an 80% win rate, but there's no way you're going to be able to predict the next 2 trades are going to be profitable. It's not possible. You can have a higher probability of it. Obviously, you've got 80% win rate, so it's higher probability, but you don't know for certain. And that is what you need to apply to your backtests. So over this 5-year period, let's say, you've got a very decently profitable strategy. It looks all good. But once you do 1,000 simulations of that strategy, so what that is doing is it's taking all the historical trades and then it's reshuffling them because you don't know the distribution. So it's reshuffling them 1,000 times and seeing, okay, how many times out of those 1,000 equity curves is it profitable or is it not profitable? And that lets you see, okay, so on average, with all these random distributions, this is still profitable or this isn't profitable. Then you've got some other methods in there that are more complex and easier, but those are normally like the common ones you want to do.
That's pretty cool, man. So that's actually very cool. Okay, now that makes sense to me. So you mentioned earlier too that you made some mistakes, some simple, basic mistakes that people typically do when they go down the route of systematic. Enlighten me. Like, what are those typical mistakes?
I think the easiest one to fall into is when you're becoming more systematic. You think complex is better. Um, I can't remember who said it, but I remember hearing from a video. Someone was like, if it was a simple edge, everyone would be doing it. There is like hidden truth in that, and there definitely is some truth in it. But for me, through all my testing and from speaking to all of these kind of other people, simpler normally does equal better results. The main reason being is the more and more you add different variables. So let's say you have like a small cap strategy and you're adding like 50 variables. You're taking legit everything under the sun and you're applying it to find that profitable edge. There's a way higher likelihood you've just overtrained your data on overtrained your strategy on historical data. Because if you think about it, if you have historical data, there will be a profitable strategy in there. That there will be, and there will be the most profitable strategy. And if you try and overfit it to find that singular most profitable strategy, you've only fitted it on historical data. But when you apply it to a live market where all this new data is coming in, it's a random distribution, you've only fitted it onto historical data, and it will no longer work on a general data. That's normally what you'd call it. So normally that's why if you have something like 4 or 5 parameters, it works better, because if it works on historical and then you do some like forward testing, so just on the live markets, you can get real proof that this is something that actually stays consistent. It works even with all these different changes. So that's normally the most common one, and one I definitely fell victim to. I thought I had to apply every single thing of what people were mentioning to find something profitable, but simpler has always been better.
You find a system that works for you, you backtest it, then you start forward testing it, and you continue to trade it. And now you've been consistently profitable for, what you said, 2 years?
Yeah, 2 years. Yeah, correct.
2 years. What would you tell yourself if you had to go back in time and go back to the beginning of your journey? What would you tell yourself to help convince yourself to get here sooner? Because, you know, you went this discretionary approach first. Like, could you have convinced yourself to try systematic right away? Do you think you could have?
Can I answer that question in 2 different ways?
Yeah, go ahead.
If I could like transplant a thought into my head and make sure I do it, it would be to start just using data earlier on and being more systematic at the beginning. Main reason for that is like, I wish when I first began, I just started something very simple, like an open to close strategy. I just focused on that, and I spent all the rest of my other time really analyzing the market, creating new ideas, seeing what works, seeing what doesn't work, but having something that's very structured and not going through all the pain of trying out different strategies and losing a ton of money and things like that. If I was just to give advice, I think I wouldn't do much different if it was only advice. The main reason being is the first year is pivotal, that you won't know what works if you don't try everything else. So there would be no way I would find like systematic trading if I hadn't gone around the discretionary route and thought about all this like large caps and things like that. If I hadn't tried all of it, I wouldn't have ever found what worked for me. So I'm not much of a person that would want to change anything of the past. But yeah, that'd at least be my advice to my beginner self.
So what would be like the hardest thing you would say for someone to go your approach, the approach of going systematic? Like, what's the hardest thing about that?
I'd say the hardest thing is probably sticking to it. I think this was also why. So I think there's the book on like the turtle traders, right? Where they gave you a strategy and like see if they could stick to it. I kind of think along the same lines. If I gave someone my strategy today and they had no experience in trading and they were just freshly new to it, they wouldn't stick to it because it looks wrong sometimes. The brain doesn't think it's correct, and you would probably go away from it. So I think the hardest part is sticking to it, but I think that is sort of solved once you are creating your own strategies, because you're putting all this time and effort into backtesting a strategy, and it is almost convincing yourself that this strategy is working. Because if you're seeing all this, like going through, thousands of line of data, and you're going through code and testing it, and you're like, this definitely works, this got an average performance of this looks really good, it convinces you that you must like stay convicted to it. And that's normally how I kind of recognize of it, but it does come as a double-edged sword. Sometimes if you are overfitting a strategy, it's very hard to accept that it's overfitted, because you spend all this time looking into the strategy, and it must be the one strategy, it must make me money, there's no way I've wasted hundreds of hours into this.
Yeah.
So like it does come as double-edged, but I think that's normally how it goes.
What's been your biggest weakness, man? I mean, even though you're consistent, like what's something you're working on right now to grow your trading to the next level?
Okay. So my biggest weakness, I'd say, historically anyway, has been not sticking to max losses. That took me a very long time to stick to. I was someone that, like on Trade Zero, the one thing I really hate about Trade Zero is they let you change your max loss. It just
Oh,
shouldn't be a
okay,
thing.
yeah.
It
Yeah,
shouldn't be a thing.
yeah.
It's like, I would always change it. I'd be like, no, 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 I'll just add another $100. It'll be fine. I'll
And you
make
could
it
do it
back.
manually, like right there.
Yeah,
Oh,
yeah.
okay, yeah.
It's just terrible. I've lost a lot of money due to that because I've just, once you're having a weak day and you're already in that weak mindset, it's so easy just to change your thing and go for a higher, amount of your equity or whatever. But the one currently that I'm probably struggling with the most is surprisingly pushing size. I think after so many years of not being profitable, or not so many years, but just so many attempts of not being profitable and not having that conviction and trust that I could actually make more money and more money, it's very difficult to put that extra $200, put that extra $300 on the line. So that's probably the thing that I've had to work the hardest on, which is so counterintuitive. I thought when I began, I was like, if I find a profitable strategy, I'll slap all my money on it. It'll be so easy. I'll just grow it all. But no, that's definitely the hardest thing at the moment.
I'm glad you brought that up because because you are systematic, and most people would think that way too. Like they think it's just that simple. Like once I have a system that works, I can just easily throw all my money in it. What are you doing to overcome that or to work through that? Like, is there a system you're developing to help you go through that, or are you just kind of like a feel kind of thing? Like, what are you doing?
So I will say it's very different for each trader. For me, I've tried pretty much all the classic approaches. So I've tried the classic, just making it like a percentage of your account, so you don't really notice it. It just kind of keeps on adding up. One thing with that is it can get really high very quickly. If you have a really good win streak and your account grows by 10, 20%, it can get really high really quickly and you don't even notice, and then you're losing a lot of money quite fast. So I didn't really like that approach. That was too much of a shock to my system for that. The weird thing, the approach that has worked is kind of shocking my system into small increment jumps. So at the moment, I was 2 months ago, I think. Yeah, 2 months ago, I was risking $300 per trade. And now I've just bumped it to 450. And then I'll probably do like another bump where I'm like maybe 550 or something.
And you
around
just
there.
do that based off of feel? Like after a month or so, you feel good? Like what do you ask yourself like to make that decision?
Um, I did like a whole Excel thing on my own where I was like really going through, okay, what needs to be checked for this to for me to size up. The one conclusion I really came from is this is maybe bad to say, but there is no like perfect time to size up.
Yeah.
You'll always have that thought that like if you size up today, tomorrow's gonna be a losing day. And
Right,
tomorrow's
right.
gonna be when everything doesn't work. So there's no perfect time. I just came to the conclusion that if I have the equity, I'm fine risking that amount of money. I just have to do it today. And that's like the change. Because I spent so long trying to be like, no, I'll wait until like my win rate is higher or something, and then I'll go for it. But things change. Market cycles change. Your win rate is going to drop. Your average profit's going to drop. So you kind of just have to go for it in a weird way.
And I'm curious though on the whole idea of your entry being a systematic trader. Do you enter just one go? Like do you just enter one go and exit one go? Like is that how you trade, or is it more so like do you have a systematic way of like quarter? Like how do you look at entries and exits when it comes to systematic wise for yourself?
Sure. So in a systematic approach, one in, one out is way easier. I would recommend to everyone to go one in, one out for most systematic systems. The only reason you need to change that is if you've got liquidity constraints, at least in my opinion. The reason for that is it's a lot easier to backtest. It's a lot easier to simulate. It's just a lot easier on most things when you're trying to get backtesting results and coding it up and everything like that. I have on futures, so on my like futures algos, I've made them have pyramiding and add to positions and exit in partials and things like that. The reason for that is futures is a lot easier to have algos running on. It's a lot more friendly to it. It's got just a better environment for algos compared to small caps. Main reason is like small caps, you've got all these crazy things like halts, you've got news halts, you've got weird liquidity constraints where liquidity drops like just a bomb and it just is done. Yeah. Whereas in futures, everything's a bit more consistent. Like you do have spikes of volatility around news and things like that. But it's just an easier environment, at least in my opinion, for algos.
So you have a system that now do your systems, let me ask you this, do your systems just execute all by themselves, or do you, I know you said earlier you have an 80-20, like an 80% systematic, 20% discretionary, but then you said on Forex, it sounds like it kind of just does it for you. So like, is that system more like the Forex system more by itself and then the equities is kind of 80-20?
Oh, so it's futures, not forex. But
Oh, sorry.
no worries. So for small caps, yeah, I trade with an 80% systematic and 20% discretion. Main reason for this is the weighing of variables. So I have coded algos for small caps and I've experimented with it. But the main thing I've always come down to is small caps, because of how cyclical it is and how many different variables can pop up. The weighing of those is very difficult. So an easy example here is just like once we had the oil run, an additional, like an algo wouldn't be able to tell that an oil run is going to change all the odds, because that oil run has just pumped in so much volume and it's changed the odds pretty much because of this new news. And that's what makes it quite difficult. So normally in small caps, the best algos to go for, or at least strategies, is normally parabolics. At least just through data wise, parabolics intraday don't get affected as much by news or by general market sentiment for small caps, whereas like a classic gapper is a lot more susceptible to it, because you've got all the multi-day runners, you've got runners that are connected, whether they're similar news or similar sector. And that's the main reason why in small caps anyway, I'm 20% discretion, so that discretion is used for weighing those variables. So some days I'll be like, because it is sort of a weaker cycle, I can accept a lower gap percentage, whether that just be like one standard deviation lower or something like that. That's how I use it. And then the 80% is all the stock selection, most of the variables pretty much, like it tells me exactly where I'd want to enter and exit, but I'm the final decision maker around that part. Whereas in futures, because we have none of that craziness of different news popping up and changing really everything, futures is a lot easier to do algos for. So for just futures, everything is, I don't really look at futures. I look at the P&L and I'm like, okay, that was a good day, that was a bad day. I sometimes add to them and change them, but that's very rare. A very slippery slope you can go down, and it's very easy to for algos. The classic thing people advertise algos as is like removing all emotion.
Right.
It's true. It does remove emotion from singular trades, but from actually the system itself, it doesn't remove any emotion. Because let's say you have a week and it's red the whole week, you're going to feel very inclined to change that system or to stop that system, or you don't want that system anymore, you're throwing it away, you absolutely hate it. And that's very easy to do. You can just go in, change the parameters, change the variables, whatever, maybe overfit it based on last week's performance, whatever. And that's what makes algos a double-edged sword. It's great for taking your thinking out of individual trades, but you still need to apply discipline and general common sense, I guess, to not change that strategy over and over and over, because it's just never going to work if you do.
Do you have a time period in mind where you will look at a system? If it's been X amount of months or weeks or years before, like, it's not doing well? Like, is there some kind of number in mind that you're like, okay, maybe we should look at this?
I think that's like the magical question. I don't think many people know the exact answer to that.
But just for yourself, like, what would you do?
Yeah. For myself, I know some common strategies are to like use EMAs. So if you have an equity curve and it like goes below an EMA on the equity curve, then you like cut it and you stop it. That for me has always been not very useful. Most of the time it cuts it too soon or it cuts it way too late. So it just kind of cancels out the impact of that. So for me, most of the time, it's based on backtesting performance. So if I have, for a particular strategy, let's say on the backtests and like Monte Carlos, it said an average drawdown is going to last 4 weeks, let's say. Like that's the average drawdown.
Right.
And the most highest drawdown ever lasted 7 weeks or something like that. I would be concerned around like week 5, week 6, and getting to those upper numbers where I'm like, okay, this is kind of not very common now. You're way above the average. It's getting to kind of the max, and then I'll start maybe looking at it. But until that point, I try and ignore it. It's not as easy as saying just ignore your strategy for that long. But yeah, it's at least what I try and do.
Dude, what I love is just how you're explaining things. I know people are probably watching this and they're like, man, like it'd be nice to know, like, if I had if the longest drawdown period for this strategy is 7 weeks, then I can expect that if I go through a drawdown period of 2 weeks, I don't need to be sweating it. Whereas most people don't know that, and they're going through it with no idea what's at the end of that tunnel. Whereas you do now. So that's like a huge superpower. Like it's like a huge superpower, which builds your confidence. So before we wrap this up, because I know people are going to want to learn more about you, and they're going to probably want to dive into this whole systematic approach. 2 things. Number one, I do want to let everyone know that you and I are collabing, and you're going to be giving away a whole how-to guide on how to backtest yourself. Take it away. This is for advanced and new traders alike, which I'm so thankful for, brother, that you're doing that. Everyone, you could download that by just clicking the link below, provide your email, and we'll send it all to you. It's completely free. But I do want to ask you this, man. On your 80-20 trading, when it's like 80% on the small caps is systematic and 20%, on that 20%, do you find yourself sometimes like making some common human errors, like maybe entering half and then half instead of just once, or entering a quarter instead of just once, like you said you would prefer? Like, do you find anything like that happening whenever you are kind of mixing the two?
Yeah, I would say it happens. I've reduced it more and more over time. It used to happen a lot more, and I was like, this doesn't seem very productive to have this discretion if it's messing everything up. So that's definitely like something to be aware of. If you're going to introduce discretion, I think Trader Dante has a list, but you should like add just a table column on your journaling and just say, did I improve the impact of the strategy or did I worsen it? Because of these decisions, was it better or was it worse? And, you know, there's a bit of hindsight trading in there, but it's still a useful exercise to do to understand, you know, does your discretion actually improve your strategy or is it just making it worse? So the common ones I've normally made mistakes on is undersizing on a trade that shouldn't be undersized. Just because I've had this feeling, I'm like, this doesn't look exactly right. I want to undersize on this. And then I lose out on more profits. I haven't had the issue of oversizing. Main reason for that is during the whole first year and, you know, year 1.5, I oversized all the time. So I've kind of like beaten that out of me. I'm like, there's no way I'm oversizing. It's just not going to happen. Not doing it. But yeah, normally undersizing. Sometimes I'll take a trade too late. So it will say, you know, I should be taking it around 5% from the open or something like that. And I take it at 10, but then I miss it because it only goes like 9% or something, you know, silly like that. So those are the common ones, but I've tried to reduce as much as possible. I just try and execute it as best I can. And then I look back on the results and say, okay, I did good. I followed it.
Do you have a one set risk for, like, as in like your 1R is equivalent for all types of trade, like all your trades? Or is it like you have like certain trades that are A plus, like do you categorize them and risk more on those? Like, how do you systemize that? Like, do you keep it all the same all across all the board? Like, how do you go approach that?
At the moment, I keep it pretty much all the same. I have planned for a long time to introduce that kind of like oversizing, or not oversizing, just adding size on better trades, on like A plus trades.
Right.
And I think I have the ability to understand what is an A plus trade for me, but I think it took a very long time. And even with data, it's not always as cookie cutter. Sometimes you'll have something that's, you know, it's got maybe a higher open to close percentage, so meaning it's got like a more of a fade, but there's only 40 samples of it. And then it's hard to weigh if 40 samples is enough to tell me that this is something that's like, you know, important, statistically significant, and I should be doing it, or if it's just 40 random trades that faded more than all the rest. So that's the hard part about identifying like an A plus setup. But yeah, no, in the future, I definitely try and add to, because I know Lance always talks about it. You should always oversize on your A plus trades.
Does. He loves that.
He loves it. He absolutely loves it, and it makes me feel bad because I'm like, damn, I'm only doing 1R on every trade, but it's at least how it is at the moment.
Okay, no worries, brother. Well, look, if people want to have any questions, want to ask more, and maybe if you might be able to explain a little bit more about what you created for everyone to have, feel free to right now.
Sure. So it's pretty much just a guide to backtesting. It goes over kind of like all the needed steps you'd want to go through to start backtesting. It goes through the first 4, which everyone can do, and then it does talk about, or at least labels the next 4 steps, which if you already have coding abilities or something like that, you can go through. But at least the first 4 everyone can do, whether you have coding or no coding experience. You can use Excel or really anything you'd like to. And for everyone to find me, it's just Go Talk Trades on Twitter. You can message me anytime. I've got open DMs, so you can always ask me questions. And that's pretty much it.
Awesome. And he's being humble here, but he also gives away an Excel starter spreadsheet. And you can even use that to actually create just a macro vision without even without doing any coding to understand the setup, which I freaking love, which I did. Even Tim Grattani did a long time ago, and he shared a long time ago. So he gives that away. So definitely check it out. Click the link below. But again, Go Talk Trade. I appreciate you, brother, being here and sharing your story, man.
Thank you so much.